CFA Level 2 Alternative Investments. This lecture is on publicly traded real estate securities. This is a relatively short reading with 8 sections. The first section is a high-level introduction to the topic. In section 2, the curriculum talks about publicly traded real estate securities. Broadly speaking, we can either have equity-based publicly traded real estate securities or debt-based. Within equity-based, we have REITs and REOCs, and within debt-based, we have various kinds of mortgage-backed securities. Mortgage-backed securities, or essentially debt-based real estate securities, are covered in the fixed income segment of the CFA curriculum. Section 3 then gets into the characteristics of REITs. Section 4 is a short section on REOCs. Sections 5, 6, and 7 talk about different valuation approaches, specifically a NAV-based approach, followed by a relative value or price multiple-based approach, and finally discounted cash flow approach. All these should look reasonably familiar. We talked about NAV at level 1 in the context of mutual funds. The same general concept is applied here to real estate. Relative value and discounted cash flow based approaches again should be familiar based on what you have seen in equity. Section 8 is a mini case study where the concepts that you have seen above are applied to a fictitious REIT. And I think from an exam perspective, it's very important to spend some time on this case study. Publicly traded real estate securities fall into two principal categories: equity and debt. On the equity side, we have equity REITs and real estate operating companies. The fundamental difference between these two securities, REITs and REOCs, is that REITs have a tax advantage and real estate operating companies do not. So to understand this, just look at the following picture. Let's say that this is a REIT. The REIT owns several properties. These properties pay rental income to the REIT since the REIT owns them. The REIT has issued shares which are owned by the REIT shareholders. The way you can think of this is that this income is coming in, there are some expenses that are subtracted, and then the net cash flow is going to the shareholders. Now, the tax advantage means that these payments to shareholders are tax deductible. So the rough analogy is that when a company makes interest payments, the interest payments are tax deductible. Similarly, the payments that are made to the REIT shareholders are also tax deductible. So essentially, the corporate tax paid by this REIT entity comes down. Obviously, the shareholders need to pay taxes based on the income that they get, but the corporate tax is down. So effectively, this avoids the problem of double taxation. And the concept defined here is generally referred to as the tax advantage for REITs. Real estate operating companies do not have this tax advantage. On the debt side, we can have mortgage REITs, commercial mortgage-backed securities, residential mortgage-backed securities. Mortgage REITs essentially make loans which are secured by real estate, and these mortgage-backed securities we will discuss in fixed income securities. On the private security side, you can have private REITs, private real estate operating companies, private mortgages, private debt, etc. But the real focus here is on the public side, and more specifically, the focus of this reading is going to be on equity REITs. There is some mention of real estate operating companies, but generally these are much less popular than equity REITs, primarily because of the tax advantage. This material, as I mentioned earlier, will be covered in fixed income. Section 3 starts with a quick overview of equity REITs and mortgage REITs. So as mentioned earlier, in a equity REIT, the REIT has a ownership stake in properties or a equity stake in different kinds of properties. In a mortgage REIT, the REIT essentially takes its assets and invests them in mortgages. A hybrid REIT is a combination of equity and mortgage, but these are not very common. Section 3.1 gives a background on REITs, and this is not very testable, so I won't spend time on it. You can read it if you want. It is interesting, but again, not testable. Section 3.2 again is, I don't think, testable. It's a very short section on REIT structure. What the curriculum points out is that many REITs are structured as UPREITs, which refers to umbrella partnership REITs. And the high level idea is as follows. We have a REIT entity, we have a partnership. The REIT owns the partnership and the partnership owns the properties. Now, the point of this structure is basically to give a tax advantage in that it helps avoid the recognition of taxable income if appreciated properties are transferred to the REIT. And again, the curriculum doesn't spend much time on this topic. There are no examples. So from a testability perspective, again, I think this is very low priority. The curriculum also mentions another kind of structure called a DAO REIT, which is simply a variant of the UPREIT. But again, I would not get too hung up on this. Section 3.3 is very important. This first talks about some high-level investment characteristics of REITs. One basic point that has already been made is that with REITs, we get exemption from corporate income taxes. So this is a good thing. The distributions to shareholders are relatively high. In fact, for this exemption to kick in, generally there are requirements that the income generated from the properties is distributed to the shareholders. So distributions are high. The third important point is that generally income volatility is low. However, the retained earnings for a REIT would generally be low. So since the money is flowing through to investors, the REIT investors, retained earnings are low. So if a REIT wants to expand by purchasing new properties or investing in new properties, then it needs to issue new equity. So given all these factors, essentially we can conclude that REITs are relatively stable, safe investments. And again, this is relatively speaking. So for investors who are looking for retirement income, if they are looking for income producing securities, REITs are generally a good investment. Now let's take a look at the advantages of publicly traded REITs and REOCs over direct investment in real estate. The first major advantage is liquidity. When you invest in publicly traded REITs or REOCs, the liquidity of this investment is much more. Clearly, if you buy an expensive property, the ability to sell that property quickly at market price is relatively low. But in an actively traded public market of REITs and REOCs, you can sell your shares, and hence this is a relatively liquid investment. Another point is that the investment requirement is relatively low. Again, with a property that you buy directly, the level of investment needed will typically be high, but with REITs and REOCs, you can get in with a relatively small amount. Third advantage is that the liability is limited. So when you buy shares, the most that can happen is that the share price comes down to zero. So you will not owe anything beyond that. Fourth point, quality and range. What this means is that through REITs, you can indirectly own properties, high quality properties such as premium office buildings that you could not own otherwise. Plus, you also get access to a range of properties which again you might not be able to directly invest in. Fifth point, with direct investment, you need to either manage the property yourself or hire an agent, a property management company to basically look after the property. So you need to have some skill either in management or in picking the right management team. With REITs, that is not an issue because the REIT entity takes care of looking after the properties. Sixth advantage is diversification. So this is obvious. Through a REIT, you can diversify into different properties across different regions and so on. The next 3 points, taxation, earnings, and payout, these refer to REITs. So as we've already discussed, there is a taxation advantage with REITs where effectively we avoid the double taxation issue, but there are some criteria that need to be met for this taxation advantage to take place, but generally REITs meet those criteria, so this is an advantage. Earnings are generally stable since the earnings or the rent that comes from properties is effectively paid out to shareholders after covering expenses. There is a fair amount of stability and predictability in the earnings. The payout ratio or the yield for REIT investors is again generally high. The advantage that REOCs have is operating flexibility. The point here is that the income that is generated from properties does not or is typically not all paid out. So we have retained earnings, and those retained earnings can be used to make other investments. So essentially, operating flexibility is the major advantage that REOCs have over REITs. Now I want you to work on example 1. Now let's take a look at some of the disadvantages of publicly traded REITs and REOCs. Let's first look at taxation. When you own property, so when you have a direct ownership in property, then the losses, if you do make losses, those losses can be used to offset other gains, or in other words, those losses can be used to reduce taxes. Whereas in a REIT, that cannot happen. So that's a disadvantage. Second disadvantage is that the control of the underlying assets or the underlying properties is low. The control happens through the REIT management, and as a shareholder, you really don't have much control over the underlying properties. Number 3, costs. Here, essentially, the maintenance of a publicly traded REIT can be relatively high. So there is a question mark in terms of whether this high cost of running or managing the REIT justifies the benefits of the REIT. The next point is that the prices of REIT shares are determined in the stock market, and these prices tend to be volatile. If we compare the REIT prices with the underlying NAV or net asset value, then the REIT prices tend to be much more volatile than NAV, and hence, at least on the surface, the riskiness of REITs is more relative to owning the underlying asset. However, this needs to be taken with a grain of salt because NAV values or the values of underlying properties are based on appraisal data, and as we have seen in the earlier readings, the volatility of appraisal data is generally understated. Next point has to do with structural conflicts. Now, as alluded to earlier, many real estate entities are organized as up REITs or down REITs, and there we have a concept of a partnership and a REIT company. Now, similar to the agency problem that you study in corporate finance, here there might be some conflicts of interest between the partnership and the REIT shareholders. There isn't much detail on this, so as long as you understand this at a high level, that's all we really need. Next point has to do with income growth. Now, given that the level of retained earnings is low, the income growth is going to be low. All the earnings or income that comes through from properties flows to the shareholders. Retained earnings low, hence income growth low. The last point has to do with equity issuance at disadvantageous prices. The point here is that REITs often use financial leverage. Now, if financial leverage has not been used properly in the past, that will make it difficult for a REIT entity to raise money in the debt market. Also, if we have a situation such as the 2008 financial crisis or credit crisis, here again, debt financing will be limited, which will force a REIT to go for equity financing, which again might be pricey, or which might not happen at suitable prices. So these are the high level disadvantages of publicly traded equity investments. Now you need to do example 2. Section 3.4 provides some guidance on the sort of due diligence that an investor should perform before investing in a particular REIT. The basic idea is fairly straightforward. When you are investing in any security, be it a REIT or even be it a stock of a company, you want to try and understand the specific characteristics of that investment, the possible opportunities and the risks. So here we talk about some aspects that you need to look at that are REIT specific, but you will clearly see parallels between what you need to do here and the analysis of a regular company stock. So the first point to look at is the lease terms. So these are essentially the REIT's agreements with the customers. So in this context, the entities that are leasing the properties are the customers. So we need to look at the lease terms. Are they favorable? How long are the leases? Whether the leases are up for renewal anytime soon. The next point is the extent to which inflation protection is built into the leases. So the way we can evaluate this is if the lease terms are expiring within a year and subsequent leases give the REIT an opportunity to raise rents based on inflation, that gives inflation protection to the REIT. The company analogy would be that if a company, when it's selling its product, is able to pass on the impact of inflation to the customer, then we can say that that security has inflation protection. So same concept here. Point 3 has to do with rent. We should evaluate the current rent that is paid by tenants relative to market rents. Now, if the current rents are low relative to market rates, then that tells us about some upside potential in the future once rents catch up with market rates. Point 4 has to do with re-leasing costs. We need to have a good sense for how much it will cost the REIT to release. So the worst case scenario here is that leases are running out soon, and then the cost to release the apartments is very high. Next, tenant concentration. So this would be analogous to studying the concentration of a given company's customers. Now, the situation that would be concerning here would be if you have a given REIT, again, let's just assume that this focuses on office space, and there are two tenants who make up 90% of the revenue or the income generated for the REIT. Now, clearly this would be a reason to be concerned because the tenant concentration is very high, and clearly not only do the tenants have significant bargaining power, but if these tenants leave, then that will have a serious impact on the cash flow for the REIT. Point 6 is competition. So who are the other players in the market? Again, let's take the office space building. So if our REIT is managing office spaces in 3 different locations, we need to look at the competitive forces in those locations. If in those 3 locations several other players are coming up with their own office spaces that are potentially better than the ones that are under this REIT, that would be a cause for concern. This would be analogous to the internal rivalry force in Porter's 5 forces. Point 7 is leverage. We need to look at the balance sheet of the REIT and look at whether there is reasonable leverage. If the leverage ratio is too high, that would potentially mean excessive financial risk. And finally, we should look at the management of the REIT. What sort of experience do they have? How long have they been at this organization, and so on. So this obviously is analogous to the evaluation of the strength of management of a given company. Most REITs specialize in a particular property type, and this allows REITs to be more efficient, especially from an operational perspective. And this is fairly easy to understand. A REIT that specializes in shopping centers will clearly be more efficient than one that tries to have shopping centers, office building, residential spaces all under its fold. So it is pretty common for REITs to focus on a particular type. And here is an exhibit from the curriculum which shows that globally 23.3% REITs focus on shopping centers, 14.5% on office buildings, and so on. And only about a third of the REITs around the world are diversified. So key point is that most REITs are specialized, which allows them to be more operationally efficient. What we need to do in this section is understand 8 different subtypes and a few core points about these subtypes. Let's start with the shopping center or retail based REITs. These typically have lease agreements between 3 and 10 years, and this is for the small retail shops within a given shopping center. The anchor stores that we have spoken about in an earlier reading typically have longer leases. Now, from an analyst perspective, one needs to look at the rental rates, one needs to look at the sales per square foot, and so on. So these are the most important characteristics. If you are reading the curriculum, I would advise you to look at the last paragraph for each of these subsections. The last paragraph highlights what an analyst should pay attention to. The next subtype is office space. Now, office spaces tend to have relatively long leases, and when we talk about office REITs, the underlying property is generally multi-tenant office properties, and these would be in business districts. From an analysis perspective, we need to look at how much new construction is going on. If there is a lot of new construction happening, that puts pressure on the rental rates, and obviously that would be a cause for concern. We also need to look at how well connected this particular office building is with other parts of the city. So the connection network in terms of trains or roads. We also need to look at the relative utility of the office space relative to what tenants are demanding. So the bigger point here is that we need to evaluate how desirable the office spaces are to potential and existing tenants. If the level of desirability is high, then obviously that's a good sign for the REIT. Next, industrial REITs. Now, this would be REITs which include warehouses, distribution centers, light manufacturing facilities, flexible space. So all this together is in the industrial subcategory. Here again, lease terms are relatively long, and from an analysis perspective, we need to look at location. Obviously, if we are considering a warehouse, then location should be such that it's well connected with highways, maybe close to a port. We also need to look at the utility of the facility for existing tenants and potential tenants. Again, overall point is how useful will the space be for tenants. With multifamily and residential REITs, we need to look at demographic factors. In other words, for example, is the age group of the population between 25 and 35, which is the age group that typically goes for apartment spaces. What is the appeal of the facility? So do potential tenants like the design of the properties? The location, is the location convenient for tenants? The cost structure is important because typically these leases are gross leases, which means that the landlord needs to pay utility bills. So these are the major factors to look at. Storage REITs refers to self-storage properties. These are also called mini warehouses. And the key factors that an analyst should look at are housing sales. If housing sales are up, that's a positive sign for self-storage properties. If general business activity is up, that means people are moving into this location or people are changing houses. That again is good for self-storage properties. Healthcare REITs cover nursing homes, assisted living facilities, hospitals, buildings for medical companies, and so on. Now, to analyze these REITs, one needs to look at what sort of government funding is available, what is the cost structure. Insurance costs can be quite high, so an analyst needs to understand how much these costs will be. One needs to understand what competitors are doing, because if there is substantial competitive activity, that will put downward pressure on the lease amounts. With hotel REITs, the key point is that they have very high exposure to the business cycle. So when the economy goes south, obviously vacancy rates are higher at hotels, so revenue or rental income goes down. The key metric that we look at with hotel REITs is the revenue per room. We also need to look at the leverage of hotel REITs, because given the seasonality of this business, high leverage can be very risky. So ideally, we want a relatively low leverage. And finally, diversified REITs. So as mentioned earlier, this would mean a combination of the REITs that we have already talked about. So clearly, to analyze diversified REITs, we need to analyze each of the subtypes of REITs that are contained within a particular diversified REIT. Section 3.6 talks about economic drivers. Here, essentially, we need to understand what factors impact the economic value of different types of properties. And the curriculum gives us 5 factors that we need to be on top of: national GDP growth, job creation, retail sales, population growth, and new space supply versus demand. I think this exhibit is what you need to stare at for a few minutes, and this is all that you really need to know for this section. Now, what has been done in this exhibit is as follows. So if you take retail space, then we are saying that national GDP growth is the most important factor. So that is number 1. The second most important factor is retail sales growth, followed by job creation, and finally population growth and supply demand. So note that the GDP growth, or the general economic growth, is the most important factor for all property types. And then depending on the property type, one of these other factors kicks in at number 2. So before you get on to example 4, just try to get a sense for this exhibit. Section 4 is a short little section which focuses on real estate operating companies, or REOCs. These, as we mentioned a few times before, are ordinary taxable corporations. So unlike REITs, they do not have a tax advantage. The income that is given out is not tax exempt. So these operate in countries that do not have a tax advantage REIT system. Other than the tax related factor, most of the advantages and disadvantages are similar to REITs. So like REITs, they allow an investor to diversify across different real estate properties. They face similar operating and financial risks as private real estate investments. Now, another key point here is that REOC investors generally make money based on capital gains. So since the rental income is generally being reinvested, the hope that the investor has is that the property that is purchased is either fixed, or after a few years when it is sold, then it is sold at a much higher price. So the return is in the form of capital gains, and hence many of the risks are similar to private real estate investments. And the final point that you need to be aware of is that equity markets generally have shown a preference to REITs. So in countries where you have a tax advantage REIT regime, you will generally find REITs and very few REOCs. So now you can do example 5, and that will bring you to the end of section 4.